again, your words, you're seeing, again, this massive disinflationary wave building,
Right.
which, again, to your thesis, it will subsequently force the Fed to pivot sooner than their forecasts call for, which will in turn lead to this big market rally. But I've also been reading some of your research notes recently, and you seem to have turned a little bearish in the short term. So
Right.
with all of these things on the horizon, why are we being bearish right now?
Right. Yeah, great point. So we need a final massive capitulation sell-off in order for these good things to happen. That's just kind of like the plain and simple truth. There's a couple reasons for that. Is one, the Fed is not going to pivot until things start breaking, right? That they want to kill inflation, and they're going to keep killing inflation. And so long as things don't break, it's kind of like a bull in a china shop. The bull is going to keep going unless it starts, wiggling like crazy, and then a bunch of china breaks. At that point in time, the bull's like, oh, like maybe it second guesses what it's doing there. But if it just keeps walking down the china shop, not breaking any glasses, not breaking any china, it's going to keep walking down the china shop. So that's what the Fed is right now. They're the proverbial bull in a china shop. And they haven't really broken any glasses yet. The stock market is kind of breaking. The bond market is kind of breaking. The housing market is kind of breaking. The commodity markets are kind of breaking. Like everything is like on the edge. These cups are on the edge, but they haven't fallen onto the floor and shattered yet. One more massive sell-off in the bond market, in the stock market, allowing more time for housing prices to really come down, allowing more time for oil prices to really come down. A couple more weeks of what we're doing right now, and these cups will start to fall onto the floor and shatter. Stock market down 20%, scary. Stock market down 30%, real panic sets in, especially if we get that sort of massive rapid sell-off. So interestingly enough, we did some analysis. The market doesn't bottom. Bear markets don't bottom until you get some sort of massive grand finale sell-off. And typically that's quantified by stocks dropping about 20% in 15 days. We didn't bottom in November 2002 until we dropped about 20% in 15 days. We didn't bottom in March 2009 until we dropped about 20% in 15 days. We didn't bottom in March 2020 until we dropped about 20% in 15 days. So this 20% in 15 days metric, that's kind of the markings of the final sell-off of a bear market. Because you need that sort of deep capitulation. Everybody throws in the towel. Everybody's giving up hope. Even the bulls are like, oh my God. And that's the point. That's the point at which we bottom. So we need to get there. We're not there yet. Right now, we're about 12% off the trailing 15-day high in the S&P 500. That's as big of a sell-off as we've seen in all of 2022. We've been falling all of 2022, but the sell-offs have never been really that sharp, historically speaking. The max sell-offs are where we are today and in June 2022. We were at both times, we were about 12% off the trailing 15-day high. So we haven't yet had that 20% capitulation sell-off in 15 days. But if we keep this up, and we drop to 3,400, which is a number a lot of people are talking about. We drop at 3,400, 3,200. We get into those levels in the next month, then you are looking at a 20% drop in 15 days. That would be historically consistent with a grand finale sell-off. That real panic will set in, and that will feel like a China just fell off the cliff and broke on the floor. If the bond market keeps doing what it's doing, if we see the 10-year go to 4.1, 4.2, I mean, we're already seeing currency destabilization across the globe, and a lot of that is because of the bond market. If we see that continue, you're going to see a lot of panic set in from central banks and from governments and from regulators. You're going to see panic set in on that front. If housing prices continue to decline in August and September and October the way they did in July, then you're going to start seeing the housing market come to a real standstill. Nobody's going to want to sell their homes. Who is going to want to sell their home? So a lot of people bought their homes over the past decade, 2 decades. That means they got mortgage rates of 3, 4, 5%. Who's going to want to sell a home at the mortgage rate they have at 3, 4, 5% to go and buy a home with a mortgage rate for 7, 8%? Right? If this housing market, especially if their home prices are dropping, what they just sold it for is probably a discount. They have to go into the market, and it's a real tough market. So I don't think that the housing market can really sustain itself at this current trajectory. So the housing market's going to start to feel like it's about to fall and hit the floor. Basically, what I'm saying is that one more short-term crash, really steep, really fast, really furious, could break enough China in this China shop to get the bull to say, oh, shit, maybe I should slow down. maybe we should not keep doing what we're doing. So
Mm-hmm.
if we do get that, then I think that we could have a very, very strong turnaround from a Fed pivot in the November, December period. That I do believe that if the inflation report in October is much softer than expected, which it should be, look at home prices, look at oil. There is no way that headline inflation number is not much, much lower than the September number. So if that happens, if stocks keep crashing, if yields keep rising, if the housing data remains weak, if the broader economic data turns much weaker, then you're going to have a Fed in November, a week before midterms, that says, okay, they're still going to hike 75, but they're going to change their mood, their rhetoric, their forecast, as opposed to rah, 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 rah. It's going to be more, well, we're going to keep up the fight, but, we notice what's going on. We're aware of those risks, so we'll keep them in mind. And that slight pivot could be enough to stabilize stocks until we get a real pivot, maybe in early 23, in which case we get a rip-roaring rally. I think 2023 is going to be a great year for stocks. But another reason we need stocks to go lower in the short term is that with the 10-year yield at 4%, that is simply that's too high for the current valuations in the stock market. So even after the recent decline, the S&P 500 is still trading at 16 times forward earnings. That means that the equity risk premium, so the spread between the earnings yield and the forward earnings yield and the 10-year treasury yield, is about 170 basis points right now. That's no bueno. That's too low. Okay. Over the past 25 years, the average has been about 200, 210, 220 basis points. And when yields are where they are right now, which is between that 3% to 4% range, normally the spread's about 300 basis points. We're at 170. So we need 130 more basis points of risk premia to get the market to a fair valuation level, historically speaking. That risk premia can either come out of yields, meaning yields got to go down 130 basis points, or they can come out of PE multiple, which means the earnings yield has to go up 130 basis points and the PE multiple has to come down. So by our numbers, with yields at 4%, 10-year at 4%, a fair PE multiple for the stock market is about 14 to 15 times. We're still at 16 times today, so we need to go lower on the PE multiple so long as yields stay higher. Not to mention that forward earnings multiple is on 2023 earnings estimates, which were at 250 and have now come down to 240 and will likely continue to trend lower. So we're really at like maybe 17 and a half times forward earnings, meaning the multiple has to go down significantly to that 14, 15 range, which we consider fair value for yields at 4%. Now, the flip side of that coin is that yields probably break at some point, and they break when the Fed capitulates. So as soon as yields break and yields come down to 3%, 2%, then the multiple can go up to 18, 19 times, and that's when you get that stock market rally. So long story short, like I said, we're waiting for inflation stabilization, yield stabilization, and Fed policy stabilization. Right now, we're only getting one of those, so stocks continue to go lower. We think the next two show up to the party over the next 2 to 3 months, and as they do, stocks stabilize and start to begin a generational turnaround in 2023, in which we think stocks can rally about 50% and certain growth stocks can rally a lot more. So short-term bearish, but long-term foaming at the mouth bullish.
Okay, so we're looking at that steep market crash followed by Fed capitulation, yield stabilization, and a subsequent, rip your face off rally. When is that going to come?
Yeah, so I think that big rally probably is reserved for early 2023. Okay. I think we're kind of in this period in the market right now. There was a period in the market from November, back in the 2008 crash, 2008, 2009, from November 2008 to March 2009. We got this big sell-off post-Lehman. The Lehman bankruptcy, and then everybody, the whole wave of bailouts and bankruptcies on Wall Street and the great financial crisis really kind of took over. We had that massive sell-off. Then there was a period from November 2008, December 2008, January 2009, February 2009, into early March 2009, where the market tried to stabilize, but it dropped about 10 to 15%. Now, during that time frame, though, certain growth stocks like an Amazon or a Netflix or a Salesforce actually rallied 30, 40, 50, 60, 70, 80% during that time frame. I think we are one big sell-off away from that era in this bear market. I think if we drop another 10 to 15% we get down to that 3,200 level on the S&P 500. That will be a moment at which we enter the November 2008 analog. Okay, we'll have that capitulation sell-off, and then stocks will sort of be range bound, not really knowing where to go, but the bias will be lower because the bias going in was very negative. So
Yeah.
during that time, the stocks kind of tread water, but ultimately go a little bit lower into early 2023. And then the Fed finally and officially capitulates. They pivot. We get a lot more. We either get a pause in rate hikes or some rate cuts. Yields come down, and I think stocks then soar throughout 2023 in the second, third, and fourth quarters of 2023. So if you're looking for a market bottom, I'm feeling a market bottom in the first quarter of 2023, but I believe those levels will be not lower than where we end the year in 2022. Having said all that, if you're looking for a growth stock bottom, I think that may have already happened actually for a lot of growth stocks. That the Dow has breached new lows for 2022. The S&P 500 has made new cycle lows. The NASDAQ has made new cycle lows, but a lot of growth stocks haven't. In fact, our top 10 portfolio in our mainstay research product is still up more than 20% from its June lows. So everything else is making new lows right now, but the really washed out growth stocks, a lot of them are not. They're still up 10, 15, 20% from their June lows. So it does feel like we're entering that November 2008 period from November 2008 to March 2009 where the markets go lower, but growth stocks stabilize, base, and then soar. So if I'm an investor, what I'm doing right now is I'm playing the macros. Short oil, I think, remains very strong. And then short semis is another one that I really like. And then what I'm also doing is I'm just hunkering down in growth stocks because those they've been completely washed out. They've been eviscerated. They've been priced for a lot of bad stuff. Now that we're in the final innings of this sell-off, those stocks are showing much more resilience than the rest of the market. And I think they continue to show resilience and will rebound before the rest of the market does. So that's where I think we are. When is the timing for all this? I think growth stocks either have already bottomed or are bottom very soon. The market probably still has another 3 to 6 months before it bottoms. But ultimately, 2023 will be a great year for both the stock market and growth stocks. It's just when that turnaround arrives. Growth stocks earlier, stock market later, probably all happens in the next 6 months. And it levels not too far below where we are today. Like I said, I think the S&P 500 at an index level can drop another 10 to 15%. That'll put us into what is consistent with bear market drawdowns of about 33%. So I think we will do that in the S&P. I think growth stocks are already pretty much wiped out. They may have already bottomed or they may retest those lows, but I don't think they go another 20% lower from here. I think they're pretty much washed out and that their rally is not getting started, but basing, which will then allow them to get into a big rally over the next 3 to 6 months.
Thanks for watching HGI Clips. For the full episode, head on over to our sister channel at Hypergrowth Investing by clicking the link in the description or listen to the podcast on any of your favorite streaming platforms. We make new episodes every Wednesday, so make sure to check it out and subscribe to never miss any of Luke's Hypergrowth insights.